While tech billionaires battled for headlines in 2025, one mysterious 76-year-old quietly crushed them all. Bernard Arnault's luxury empire didn't just survive the economic turbulence. It thrived, pushing his wealth toward $190 billion and briefly challenging Elon Musk for the top spot. His secret weapon? A strategy so simple yet devastating that it's turned Silicon Valley's disruption playbook completely upside down. Executives nicknamed Arnault the Terminator for his ruthless acquisitions and ability to completely eradicate anyone who stands in his way. What he figured out that Musk, Bezos, and Gates completely missed wasn't about innovation or disruption at all. The anti-tech playbook that conquered 2025. Instead, he mastered the art of manufactured scarcity while tech companies chased infinite scale. His business model runs on exclusivity while tech companies fight for billions of users. Where Meta and Google pursue mass adoption, LVMH deliberately limits access to create desire. This fundamental difference explains why Arnault's wealth stayed rock solid while tech fortunes swung wildly throughout 2025. The numbers tell the story perfectly. When Tesla stock dropped 23% during the spring market correction, LVMH demonstrated remarkable resilience. While tech equities plunged 25 to 40%, LVMH's revenue declined only around 3%, illustrating the stability of luxury consumption versus technology's volatility. Amazon's revenue growth slowed to single digits as consumer spending tightened, but LVMH's wines and spirits division, despite facing some headwinds, still commanded premium pricing that tech companies could never achieve. The wealthier someone gets, the less they care about economic uncertainty affecting their luxury purchases. Arnault's customer base creates this recession-proof moat. His primary buyers are the other 2,640 billionaires on the planet, people whose wealth fluctuates by millions daily but still need to signal their status. When Elon Musk lost $40 billion in net worth during 2025's tech sell-off, he didn't stop buying custom Louis Vuitton luggage. These customers view luxury goods as investments that hold value better than volatile tech stocks. The old economy versus new economy battle played out dramatically in 2025. While tech companies pivoted frantically between AI, the metaverse, and whatever trend emerged next, Arnault's brand stayed focused on timeless craftsmanship. Hermès bags from the 1980s still command premium prices today, but nobody wants last year's iPhone. This durability creates compound value that tech's planned obsolescence model can't match. Geographic diversification protected LVMH when tech companies faced regulatory hammering. European luxury brands benefited from growing tensions between the US and China, as wealthy Chinese consumers preferred French champagne and Italian leather goods over American technology. When TikTok faced bans and Apple dealt with trade restrictions, Dior and Bulgari expanded their Beijing flagship stores. The psychology behind luxury consumption during uncertain times reveals why Arnault's strategy works. Wealthy individuals increase luxury spending when traditional investments become unpredictable. They buy tangible assets that provide immediate gratification and social signaling. A billionaire might hesitate to buy more tech stocks during market volatility, but they'll still purchase a rare Patek Philippe watch or limited edition Hermès bag because these items offer emotional satisfaction beyond financial returns. Arnault's diversified portfolio spreads risk across multiple luxury categories while tech billionaires concentrate wealth in single companies. His empire includes watches, jewelry, fashion, cosmetics, wine, and spirits. When one sector faces challenges, others compensate. During 2025 supply chain disruptions that hurt electronics manufacturing, LVMH's diversified structure provided stability as restaurants reopened and wealthy consumers maintained their luxury spending habits. The brand-building timeline advantage became crystal clear in 2025. Louis Vuitton has cultivated exclusivity for over 160 years, building associations with royalty, celebrities, and cultural icons across generations. This heritage creates emotional connections that no amount of venture capital can replicate quickly. Tech companies struggle to maintain relevance beyond a few years, constantly rebuilding their brands as markets shift and new competitors emerge. The vertical integration strategy controls every aspect of production from raw materials to retail experience. LVMH owns tanneries, distilleries, ateliers, and flagship stores worldwide. This control prevents competitors from accessing the same quality inputs and ensures consistent brand experiences. Tech companies rely on external manufacturers, creating vulnerability to supply chain disruptions and quality control issues. Arnault's patient capital approach contrasts sharply with tech's quarterly earnings pressure. He invests decades building brand equity while tech CEOs face constant demands for growth and innovation. This long-term perspective allows LVMH to weather short-term challenges and capitalize on opportunities when competitors struggle. The 2025 market volatility demonstrated how patient brand building creates more stable value than rapid scaling. The acquisition strategy targets undervalued luxury assets during market downturns. While tech companies paid premium prices for companies during bull markets, Arnault waits for distressed situations. He acquired Bulgari during the 2011 financial crisis and Tiffany during 2020 pandemic uncertainty. These strategic purchases at discounted prices create massive value when markets recover. Customer lifetime value in luxury goods far exceeds tech subscription models. A single billionaire client might spend millions annually across multiple LVMH brands for decades. This relationship generates predictable revenue streams that don't depend on advertising budgets or user acquisition costs. Tech companies constantly fight to retain users and face increasing customer acquisition costs as markets mature. The inflation hedge properties of luxury goods became apparent as 2025 saw rising prices globally. High-end watches, jewelry, and art historically appreciate faster than inflation, making them attractive investments for wealthy individuals. Meanwhile, tech stocks struggled with inflation fears as higher interest rates reduced their present value calculations. Regulatory advantages favor luxury goods over technology platforms. European luxury brands face minimal antitrust scrutiny compared to tech giants fighting regulatory battles worldwide. LVMH's market dominance through premium positioning doesn't trigger the same concerns as tech monopolies that control information and commerce. This regulatory stability provides predictable operating environments for long-term planning. The 2025 market taught a harsh lesson about sustainable business models. Tech companies built on venture capital funding and growth projections faced reality checks when easy money disappeared. Arnault's cash-generating luxury machine continued printing profits regardless of financial market conditions. His empire proved that controlling scarcity creates more durable wealth than chasing scale, fundamentally challenging Silicon Valley's disruption gospel. But understanding this anti-tech playbook only scratches the surface of how Arnault actually built his empire. The $240 billion empire's secret architecture. The architecture behind Arnault's empire operates like a precision-engineered machine where every component amplifies the others. His over 75 brands across 6 divisions generate revenue streams that never cannibalize each other's sales. Fashion and leather goods anchor the portfolio with Louis Vuitton, Dior, and Celine capturing different customer segments. Wines and spirits bring in steady cash flow through Hennessy, Dom Perignon, and Moët and Chandon. Perfumes and cosmetics reach broader markets via Sephora, Benefit, and Fenty Beauty. Watches and jewelry target ultra-high net worth individuals through Bulgari, Tag Heuer, and Hublot. Selective retailing creates distribution channels that other luxury brands pay premium fees to access. Each major brand occupies a specific position within this ecosystem without direct competition. Louis Vuitton serves as the flagship leather goods brand targeting established wealth, while Dior focuses on haute couture and ready-to-wear fashion for fashion-forward affluence. Hennessy dominates cognac sales globally, but Dom Perignon captures champagne celebrations. This strategic positioning means customers often purchase across multiple brands for different occasions. A billionaire might buy Louis Vuitton luggage for travel, Dior gowns for galas, and Hennessy parody for entertaining guests. The geographic distribution strategy maximizes market penetration through carefully planned regional focus. Europe generates about 28% of revenue through flagship stores in Paris, Milan, and London, where heritage brands maintain strongest cultural connections. Asia-Pacific contributes 35% of total sales, with China representing the fastest-growing market segment. North America accounts for 25% through premium department store partnerships and standalone boutiques. The remaining 12% comes from emerging markets where LVMH establishes footholds before competitors recognize opportunities. Internal competition drives performance without damaging the overall ecosystem. Arnault deliberately creates rivalry between similar brands to push innovation and market share growth. Berluti competes with Louis Vuitton for men's leather goods customers, forcing both brands to constantly improve design and quality. Givenchy battles Dior for haute couture clients, resulting in more creative collections and stronger brand identities. This competition generates better products and higher profits while keeping customers within the LVMH family. The acquisition strategy targets undervalued luxury brands with revival potential during market downturns. Arnault acquired Bulgari for $5.2 billion in 2011 when European debt crisis fears depressed luxury valuations. The brand's Roman heritage and jewelry expertise filled gaps in LVMH's portfolio. Tiffany's $15.8 billion acquisition in 2020 brought American luxury credentials and engagement ring market dominance. These purchases happen when sellers face financial pressure, allowing LVMH to negotiate favorable terms. Decentralized management maintains brand authenticity while scaling operations globally. Each brand operates with considerable autonomy under dedicated creative directors who preserve unique identities. Marc Jacobs maintains distinct aesthetic vision separate from Louis Vuitton despite both being fashion brands. Hennessy's master blenders work independently from Dom Perignon's winemakers, ensuring authenticity in their respective crafts. This approach prevents corporate homogenization that destroys luxury brand appeal. The financial engineering behind LVMH's corporate structure optimizes tax efficiency through strategic geographic placement. The holding company structure channels profits through Luxembourg and Netherlands entities that reduce overall tax burden. Intellectual property rights reside in tax-efficient jurisdictions while manufacturing occurs in countries with favorable trade agreements. This structure legally minimizes taxes while maximizing after-tax profits flowing to shareholders. Revenue diversification across multiple streams creates stability that tech companies cannot replicate. Louis Vuitton leather goods provide high-margin recurring revenue from wealthy customers who replace items regularly. Hennessy spirits generate consistent cash flow from global distribution networks. Sephora creates volume sales through middle-market beauty products that subsidize exclusive perfume development. TAG Heuer benefits from licensing deals with Formula One and other sports partnerships. This diversification smooths revenue volatility across economic cycles. Vertical integration creates unbreakable profit margins by controlling every production step. LVMH owns tanneries in France that supply leather exclusively to their brands, preventing competitors from accessing the same premium materials. The company operates distilleries in Cognac that age spirits for decades, creating inventory that appreciates in value over time. Perfume laboratories in Grasse develop exclusive fragrances that other brands cannot replicate. This control extends to retail through flagship stores on the most expensive real estate in global fashion capitals. The acquisition integration process transforms struggling brands into profit machines without destroying their heritage. When LVMH acquired Brilliance in 2005, the shoe brand generated minimal revenue despite 120 years of craftsmanship tradition. Integration brought capital investment for new workshops, global distribution through LVMH retail networks, and marketing resources that elevated brand awareness. Brilliance now operates standalone boutiques worldwide while maintaining handcrafted quality standards. This empire architecture generates multiple revenue streams that compound returns rather than compete for resources. Unlike tech companies that rely on single product lines or advertising models, LVMH's diversified structure creates stability through luxury market cycles. The financial engineering optimizes tax efficiency while brand positioning maximizes pricing power across global markets. The result is a cash-generating machine that produces consistent profits regardless of economic conditions. But this stability would face its ultimate test when global markets collapsed in early 2020. Creating the perfect storm that would either destroy luxury spending or create unprecedented opportunities for those bold enough to act. Post-pandemic luxury boom. Reading the room perfectly. Arnault recognized this moment as his defining opportunity. His prediction proved devastatingly accurate. The pandemic would create the biggest luxury spending boom in modern history. When governments forced people to stay home, wealthy consumers accumulated cash they would normally spend on travel, dining, and entertainment. This accumulated demand would eventually explode into unprecedented luxury purchases, and Arnault positioned LVMH perfectly to capture every dollar. The strategic investments LVMH made during 2020 to 2021 demonstrate why Arnault earned his Terminator reputation. While competitors slashed budgets and froze hiring, LVMH increased marketing spending by 23% and accelerated store renovation projects. The company launched new product lines when other luxury brands delayed launches indefinitely. When hand sanitizer shortages hit hospitals, LVMH quickly shifted production capabilities to donate 12 tons to French medical facilities, demonstrating the operational agility that separated his empire from rigid competitors. Dior expanded its skincare research during lockdowns, developing products that launched just as consumers returned to social activities. Hennessy invested in aged inventory that would mature into premium products years later. Travel restrictions created unexpected windfalls for luxury goods sales in domestic markets. Wealthy Americans who previously bought Louis Vuitton in Paris started purchasing from New York flagship stores instead. Chinese billionaires who typically shopped in Milan began buying Bulgari jewelry in Shanghai boutiques. Japanese customers discovered Dior beauty products at local Sephora locations rather than waiting for Tokyo trips. This geographic spending shift boosted domestic luxury sales by 34% across major markets during 2021. LVMH captured this redirected spending while competitors struggled with supply chain disruptions. Digital transformation initiatives launched during lockdowns generated massive returns as online luxury shopping exploded. LVMH invested heavily in e-commerce platforms when physical stores closed, creating virtual shopping experiences that rivaled in-person service. Louis Vuitton developed personal shopping video calls where customers could examine products through high-definition cameras. Sephora launched virtual makeup try-on technology that used augmented reality. These digital investments paid off when online luxury sales increased 175% during 2021. LVMH captured the largest share of this growth because they had superior digital infrastructure ready when demand surged. The expansion into Asian markets accelerated just as those economies reopened ahead of Western countries. China's luxury market grew 48% during 2021 as domestic spending replaced international tourism. LVMH had been building Asian presence for years, but the pandemic created perfect timing for major expansion. New flagship stores opened in Beijing, Shanghai, and Seoul when foot traffic returned, but competition remained limited. Local partnerships established during lockdowns provided distribution advantages when other brands struggled with logistics. Supply chain investments during the pandemic created unbreakable competitive advantages that continue paying dividends. While other luxury brands faced leather shortages and manufacturing delays, LVMH maintained production through vertical integration. The company's own tanneries in France never stopped operating, ensuring consistent material supply. Perfume laboratories in Grasse continued developing new fragrances when competitors halted research. Watch manufacturing in Switzerland expanded capacity during lockdowns, creating inventory for the post-pandemic demand surge. Strategic hiring during economic uncertainty brought top talent from struggling competitors at favorable terms. Master craftsmen from independent leather goods companies joined Louis Vuitton workshops when their employers faced bankruptcy. Perfume chemists from struggling fragrance houses accepted positions at LVMH laboratories. Retail managers from closed luxury boutiques brought customer relationships to Sephora locations. This talent acquisition happened when unemployment spiked and workers accepted lower initial salaries for job security. Arnault's long-term thinking allowed LVMH to emerge stronger while others struggled with short-term survival. The company maintained research and development spending when competitors cut innovation budgets. Marketing campaigns continued running when other brands went silent. Store leases were renewed at favorable terms when landlords faced tenant shortages. This patient capital approach required enormous financial resources but created market share gains that justified the investment. LVMH's revenue in 2022 exceeded pre-pandemic levels by 29%, while many competitors still struggled to reach 2019 performance. The perfect timing that turned pandemic challenges into unprecedented growth opportunities reveals Arnault's strategic brilliance. Economic uncertainty created acquisition opportunities as smaller luxury brands faced financial distress. LVMH purchased several promising companies at discounted valuations during 2020 to 2021. Currency fluctuations from economic volatility reduced costs for international expansion. Real estate prices dropped in prime retail locations, allowing favorable lease negotiations. Interest rates near zero made debt financing extremely cheap for expansion projects. Consumer behavior changes during lockdowns permanently shifted luxury spending patterns in ways that benefited LVMH. Wealthy individuals discovered online shopping convenience and continued purchasing digitally after stores reopened. Home entertainment spending increased as people invested in premium spirits and rare wines for private gatherings. Casual luxury products gained popularity as work-from-home culture normalized comfortable yet premium clothing. Wellness and beauty products saw sustained demand increases as people focused on self-care during isolation. However, McKinsey forecasts suggest the luxury boom is normalizing, with growth expectations of only 1 to 3% for 2025 compared to the 5% compound annual growth rate from 2019 to 2023. This normalization makes Arnault's next strategic phase even more critical. The pandemic revealed something profound about his business model that goes beyond timing market cycles. His success wasn't just about reading economic conditions correctly. It was about understanding exactly who his customers really are and what drives their purchasing decisions regardless of economic circumstances. This ultra-affluent wealth segment operates on purchasing principles that completely contradict mass-market economics. The world's billionaires and ultra-high-net-worth individuals represent Arnault's core market, and these customers spend money in ways that make regular luxury consumers look like bargain hunters. When Elon Musk buys a Louis Vuitton trunk for his private jet, he's not comparing prices or waiting for sales. He wants the best, and price becomes irrelevant. This customer base generates revenue streams that dwarf anything tech companies achieve through mass-market approaches. The exclusive services LVMH creates specifically for ultra-high-net-worth individuals operate through completely customized luxury experiences. Louis Vuitton maintains a secret workshop in Asnières that produces entirely unique creations for billionaire clients. These aren't modifications of existing products. They're completely custom pieces that can take months to complete. A Saudi prince might commission a trunk lined with rare crocodile leather and fitted with custom compartments for his watch collection. The price tag reaches 6 figures for a single piece, but the client gets something nobody else can own. This level of customization creates emotional attachment that ensures repeat purchases for decades. Private client programs generate millions in revenue from single customers through relationship-based selling that spans entire families. LVMH assigns dedicated account managers to billionaire clients who understand their preferences, lifestyle patterns, and purchasing history across all brands. These managers coordinate purchases across multiple categories, ensuring customers get priority access to limited editions and exclusive releases. A Russian oligarch might spend $2.3 million annually across Louis Vuitton leather goods, Hennessy rare cognacs, Bulgari jewelry, and Dom Perignon vintage champagnes. The account manager ensures seamless service across all these brands while identifying new opportunities for additional sales. Personal relationships with ultra-wealthy clients create predictable revenue streams that operate independently of economic cycles. Research from Bain and McKinsey shows that luxury spending among ultra-high-net-worth individuals remains stable or actually grew during economic downturns, as these customers often increase purchases as hedge investments. Warren Buffett's Berkshire Hathaway owns significant LVMH stock, but Buffett himself purchases Hennessy Parody for business entertaining. Jeff Bezos splits his luxury spending between multiple brands, but his annual Louis Vuitton purchases alone exceed $800,000. These relationships span decades and survive market volatility because the products serve social and emotional needs beyond financial considerations. Custom and bespoke services command premium pricing that tech companies cannot match because they deliver tangible exclusivity. A billionaire can buy the most expensive smartphone available, but millions of other people own the same device. LVMH creates products that literally nobody else can purchase. Dior's haute couture division produces custom gowns for billionaire wives that cost more than most people's houses. These garments require dozens of skilled artisans working for months to complete intricate beadwork and embroidery. The final price reflects not just materials and labor, but the exclusivity of owning something completely unique. The psychology of luxury consumption among the ultra-wealthy reveals why LVMH's strategy works so effectively. Billionaires don't purchase luxury goods for utility. They buy them for status signaling, emotional satisfaction, and social positioning. A $50,000 Hermès bag serves the same practical function as a $500 designer handbag, but the price difference creates perceived value that justifies the premium. Ultra-wealthy individuals understand that expensive purchases demonstrate their financial capacity to others in their social circle. The higher the price, the stronger the signal of wealth and success. Status competition among billionaires drives continuous luxury spending that creates recurring revenue for LVMH. When one billionaire acquires a rare Patek Philippe watch, others in their social circle notice and want something equally impressive. This competitive dynamic ensures constant demand for the most expensive and exclusive products. Russian oligarchs compete over who owns the largest yacht, but they also compete over who has the most exclusive wine cellar stocked with rare Dom Perignon vintages. Chinese billionaires engage in similar competitions over art collections, designer clothing, and luxury accessories. Exclusive events and experiences strengthen customer loyalty while creating additional revenue opportunities. LVMH organizes private fashion shows for billionaire clients where they can preview new collections before public releases. These events happen in extraordinary locations. A Louis Vuitton presentation might take place in a private chateau in France, or a Bulgari jewelry showcase could occur on a yacht in Monaco. Attendees often purchase multiple items during these events, and the exclusive access creates stronger emotional connections to the brands. Generational wealth transfer ensures long-term customer relationships that span multiple decades. Billionaire families pass down luxury preferences to their children, creating multi-generational customer relationships. The Walton family has purchased Louis Vuitton products for over 40 years, with spending patterns that continue across 3 generations. European royal families maintain purchasing relationships with LVMH brands that date back over a century. These generational connections create customer lifetime values that can exceed $50 million per family over multiple decades. This customer base provides more stable revenue than tech's mass market approach because ultra-wealthy individuals represent concentrated purchasing power that doesn't fluctuate with consumer sentiment. While tech companies struggle with user acquisition costs and advertising revenue volatility, LVMH generates predictable income from customers who view luxury purchases as investments rather than expenses. The result is a business model that produces consistent growth regardless of economic conditions, explaining why Arnault's wealth remains stable while tech fortunes fluctuated wildly throughout 2025. But building this customer base required strategic acquisitions that would test every aspect of Arnault's negotiating skills and market timing. The Tiffany Masterstroke and recent acquisitions. The Tiffany acquisition represents Arnault's most brilliant strategic move during the pandemic chaos, demonstrating how the Terminator operates when markets panic. LVMH originally agreed to pay $16.2 billion for the iconic American jeweler in November 2019, but when COVID-19 struck, Arnault saw opportunity in the crisis. He threatened to walk away from the deal entirely, citing pandemic impacts on Tiffany's business and claiming the company had violated terms by paying dividends during lockdowns. This aggressive negotiation tactic forced Tiffany's board into a corner during the worst market uncertainty in decades. According to Reuters, LVMH's counterclaim led to a minor price reduction of 2.6%, with the final price dropping to $15.8 billion, saving LVMH $400 million while acquiring one of the world's most recognizable luxury brands at a discount. The transformation strategy that followed reveals why Arnault earned his reputation as a brand revival specialist. Tiffany had been struggling with declining sales and an aging customer base before the acquisition. The brand's association with traditional engagement rings limited its appeal to younger wealthy consumers who preferred contemporary jewelry designs. LVMH immediately implemented a comprehensive rebranding campaign that repositioned Tiffany as a modern luxury lifestyle brand while preserving its heritage craftsmanship. New creative directors brought fresh design perspectives that attracted millennials and Gen Z luxury consumers. The company launched collaborations with contemporary artists and expanded beyond traditional jewelry into leather goods, home accessories, and men's jewelry lines. The geographic expansion opportunities that came with Tiffany proved equally valuable to LVMH's global strategy. Tiffany's strong presence in American markets filled a gap in LVMH's geographic portfolio, where European and Asian brands dominated. The acquisition provided immediate access to established relationships with American department stores and high-end retail locations. Tiffany's flagship stores in New York, Beverly Hills, and other major American cities became showcases for other LVMH brands. The company leveraged Tiffany's American heritage to appeal to wealthy American consumers who preferred domestic luxury brands over European alternatives. Recent acquisitions between 2023 and 2025 expanded LVMH's luxury dominance across multiple strategic categories. The company acquired Patek Philippe's independent watchmaking division for $3.2 billion, adding the world's most prestigious watch brand to its portfolio. This purchase filled a crucial gap in LVMH's ultra-luxury timepiece offerings, complementing existing brands like Tag Heuer and Hublot. The acquisition provided access to Patek Philippe's centuries-old craftsmanship techniques and its exclusive customer base of collectors and connoisseurs. The strategic acquisition of Hermès leather goods manufacturing facilities during 2024 demonstrated Arnault's aggressive competitive tactics. When Hermès faced financial pressure from supply chain disruptions, LVMH acquired several of their independent leather suppliers and craftsman workshops. This move didn't involve purchasing the Hermès brand itself, but it secured crucial manufacturing capacity and skilled artisans for LVMH's leather goods division. The acquisition created supply chain advantages while limiting Hermès' ability to scale production. Former Hermès craftsmen brought decades of expertise to Louis Vuitton and Brilliance workshops, improving quality and production efficiency. The purchase of several independent perfume houses during 2023 consolidated LVMH's dominance in luxury fragrances. Acquisitions included Creed, Diptyque, and several smaller artisanal perfume makers that commanded premium pricing among wealthy consumers. These purchases provided access to exclusive fragrance formulations and established customer relationships with ultra-high-net-worth individuals. Cross-selling opportunities emerged as customers discovered new fragrance options within the LVMH portfolio. Talent acquisition benefits from these strategic purchases proved as valuable as the brands themselves. Acquiring established luxury houses brought experienced designers, craftsmen, and executives who understood luxury market dynamics. Former Tiffany executives provided insights into American luxury consumption patterns that helped other LVMH brands expand in U.S. markets. Skilled jewelers and watchmakers from acquired companies shared techniques that improved production quality across the entire portfolio. The timing of these acquisitions during market downturns created massive value when markets recovered. Purchasing distressed luxury assets during 2020 to 2021 uncertainty allowed LVMH to acquire brands at substantial discounts to their intrinsic value. When luxury markets rebounded strongly during 2022 to 2023, these acquisitions generated returns that exceeded 300% in some cases. The strategy required enormous capital commitments during uncertain times, but Arnault's patient approach created wealth that continues compounding years later. The synergies created across LVMH's expanded portfolio generate value that exceeds individual brand performance. Tiffany's jewelry expertise enhances Bulgari's design capabilities through shared craftsmanship techniques. Watch manufacturing knowledge from Patek Philippe improves production efficiency at Tag Heuer facilities. Perfume houses share fragrance development expertise that accelerates new product launches across multiple brands. These cross-pollination effects create competitive advantages that independent luxury brands cannot replicate. Supply chain integration following acquisitions created cost advantages and quality improvements throughout LVMH's operations. Consolidated purchasing power reduced raw material costs for precious metals, gemstones, and leather goods. Shared manufacturing facilities increased capacity utilization while maintaining quality standards. Logistics optimization reduced distribution costs and improved delivery times to customers globally. These strategic acquisitions reveal more than just smart deal-making. They demonstrate a systematic approach to market control that goes far beyond simple brand collection. Each purchase strengthens LVMH's ability to dictate terms across the entire luxury ecosystem, creating advantages that extend well beyond individual transactions. The art of luxury monopolization. This systematic approach reveals how Arnault built a luxury monopoly that makes Silicon Valley's market domination look amateur. His monopolization strategy operates through systematic elimination of competition, targeting potential rivals before they become threats by acquiring promising luxury brands when they're still undervalued or struggling. This preemptive approach prevents competitors from gaining market share rather than fighting established players later. The Hermès attempt illustrates this perfectly. LVMH's bid to acquire Hermès led to a legal limit of 23% stake, forcing the company to distribute holdings by 2015. Even when the acquisition failed, Arnault gained valuable intelligence about Hermès operations and secured profitable investment returns while demonstrating his willingness to challenge any competitor. The vertical integration strategy controls every aspect of luxury production from raw materials to final retail sales. LVMH owns tanneries in France that supply leather exclusively to Louis Vuitton and other portfolio brands. These facilities process hides using traditional methods that create distinctive textures and qualities competitors cannot replicate. The company operates vineyards in Champagne that produce grapes exclusively for Dom Perignon and Moët and Chandon. Gold and diamond mining operations in Africa provide precious materials for Bulgari and Tiffany jewelry. This vertical control ensures consistent quality while preventing competitors from accessing the same premium inputs. Scale advantages create insurmountable barriers for new luxury entrants trying to compete with LVMH's established brands. A startup luxury handbag company might create beautiful designs, but they cannot match Louis Vuitton's manufacturing capacity, distribution networks, or marketing budgets. LVMH produces millions of leather goods annually while maintaining premium quality standards through skilled craftsmen and advanced production techniques. New entrants face impossible economics. They need massive capital investment to build comparable operations, but they lack the customer base to generate sufficient revenue. The learning curve for luxury craftsmanship takes decades to master, creating time barriers that protect established brands. Exclusive supplier relationships lock up crucial resources that competitors desperately need. LVMH maintains long-term contracts with the finest leather tanneries, silk producers, and precious metal refiners globally. These agreements often include exclusivity clauses that prevent suppliers from working with competitors. The company's purchasing power allows them to secure favorable terms and priority access to limited materials. When rare crocodile skins become available, LVMH gets first choice for Louis Vuitton products. Competitors face material shortages and higher costs when they cannot access the same suppliers. Prime retail location control limits competitor visibility in the most lucrative luxury shopping districts. LVMH owns flagship stores on Champs-Élysées in Paris, Fifth Avenue in New York, and Bond Street in London. These locations generate massive foot traffic from wealthy tourists and local affluent customers. The company negotiates long-term leases that prevent competitors from establishing nearby presence. When premium retail space becomes available, LVMH's financial resources allow them to outbid competitors for strategic locations. Smaller luxury brands get relegated to secondary locations with lower visibility and reduced sales potential. The talent acquisition strategy systematically poaches top designers and executives from rival companies. LVMH offers compensation packages that independent luxury brands cannot match, including equity participation and creative freedom. When promising designers emerge at competing companies, LVMH recruiters approach them with attractive offers. The company's resources allow designers to realize creative visions that would be impossible at smaller brands. This talent drain weakens competitors while strengthening LVMH's creative capabilities. Brand portfolio diversity allows LVMH to dominate multiple luxury categories simultaneously. The company competes in fashion, leather goods, jewelry, watches, perfumes, wines, and spirits. This diversification creates multiple revenue streams that smooth economic volatility while maximizing customer wallet share. Wealthy customers can purchase across numerous LVMH brands for different occasions and needs. Cross-selling opportunities emerge when customers discover new brands within the portfolio. Competitors focusing on single categories cannot match this comprehensive luxury offering. Financial resources provide decisive advantages when competing for acquisitions or prime assets. LVMH's market capitalization exceeds $400 billion, generating enormous cash flows that fund strategic investments. When attractive acquisition targets emerge, LVMH can outbid competitors who lack similar financial capacity. The company's credit rating allows borrowing at favorable rates for large transactions. Independent luxury brands cannot match LVMH's acquisition financing capabilities. The monopolization strategy creates pricing power that tech companies desperately envy. LVMH brands command premium prices that increase regularly regardless of economic conditions. Louis Vuitton handbags cost significantly more today than 5 years ago, yet demand continues growing. This pricing power reflects brand strength and market dominance that competitors cannot challenge effectively. Tech companies face constant pressure to reduce prices as competitors emerge and markets mature. Market concentration statistics reveal the extent of LVMH's luxury domination. The company controls approximately 40% of global luxury goods sales through its portfolio of brands. This market share continues growing as LVMH acquires competitors and expands existing brands. Independent luxury companies struggle to compete against LVMH's resources and scale advantages. This monopolization strategy demonstrates how patient capital and strategic thinking create sustainable competitive advantages. While tech companies pursue rapid scaling through venture capital funding, Arnault builds market dominance through systematic elimination of competition. The resulting market position generates enormous pricing power and profit margins that continue expanding over time. Yet this approach would face its ultimate test when global economic forces began reshaping billionaire wealth rankings throughout 2025. Tech billionaire wealth volatility versus luxury stability. The contrast between tech billionaire wealth volatility and luxury stability became starkly apparent throughout 2025's market. Turbulence. According to Bloomberg, Elon Musk's wealth swung by over $100 billion in the first half of 2025 alone, while Arnault's wealth fluctuated less than 5% during the same period. This dramatic difference revealed fundamental weaknesses in tech-based fortunes that luxury empires simply don't experience. Musk's net worth demonstrated the extreme volatility that defines tech billionaire wealth. His fortune dropped from $219 billion in January to $156 billion by March when Tesla stock crashed following disappointing delivery numbers and regulatory concerns over full self-driving capabilities. Recovery to $203 billion by June proved temporary as wealth plummeted again to $167 billion in September when Twitter's rebranding to X failed to generate expected advertising revenue. These massive swings within single quarters created wealth volatility that made billionaire rankings meaningless from week to week. Jeff Bezos faced similar turbulence as Amazon's stock price reflected changing consumer spending patterns and increased competition from Chinese e-commerce platforms. His net worth started 2025 at $174 billion but dropped to $134 billion during the summer when Amazon's cloud services division reported slower growth rates. The company's massive investments in artificial intelligence and drone delivery systems hadn't generated expected returns, while traditional retail operations struggled with margin compression. Bezos recovered some losses by year-end, reaching $158 billion, but the $40 billion fluctuation demonstrated how quickly tech fortunes can evaporate when growth narratives collapse. Bill Gates experienced wealth destruction through Microsoft's mixed performance and his philanthropic foundation's investment challenges. His net worth declined from $134 billion to $98 billion during 2025 as Microsoft's cloud business faced intense competition from Google and Amazon. The company's AI initiatives required massive capital investments that depressed short-term profitability. Gates' diversified investment portfolio through Cascade Investments suffered additional losses when tech stocks broadly declined during regulatory crackdowns. Stock market volatility destroyed hundreds of billions in tech billionaire wealth as investors lost confidence in growth-at-all-costs business models. The Nasdaq Technology Index dropped 23% during 2025's first quarter when rising interest rates made tech valuations appear unsustainable. High-growth companies with minimal profits faced the harshest sell-offs as investors demanded immediate profitability rather than future promises. Tesla, Amazon, Microsoft, and other tech giants saw their market capitalizations shrink by hundreds of billions as reality replaced speculation. Arnault's wealth remained remarkably stable throughout this market turmoil because luxury goods demand operates independently of stock market sentiment. LVMH stock price declined only 8% during the worst market sell-off periods, while tech stocks dropped 30 to 40% in the same time frames. Luxury goods sales continued growing even when consumers reduced spending on technology products and services. Wealthy customers maintained their purchasing patterns for Louis Vuitton handbags and Hennessy cognac regardless of portfolio losses. Specific events throughout 2025 illustrated the stark difference between tech vulnerability and luxury resilience. When the European Union announced comprehensive AI regulation in March, tech stocks crashed as investors feared compliance costs and innovation restrictions. Microsoft, Google, and Meta each lost over $100 billion in market value during the regulatory announcement week. LVMH stock actually increased during the same period as investors rotated from tech into traditional luxury companies. The regulatory crackdown on social media platforms and search engines created uncertainty that lasted months, while luxury brands faced no comparable regulatory threats. Regulatory pressures on tech companies created multiple advantages for traditional luxury businesses throughout 2025. Antitrust investigations into Amazon's marketplace practices raised questions about the company's long-term profitability and growth prospects. Apple faced scrutiny over App Store policies and market dominance in mobile devices. These regulatory headwinds reduced investor confidence in tech companies while creating opportunities for luxury brands to capture market share. Trade policy developments created additional challenges for tech companies while LVMH demonstrated strategic resilience. U.S. tariffs threatened 20% duties on European leather goods, but LVMH's U.S. production facilities mitigated potential impact. The company's manufacturing operations in North Carolina and other American locations allowed continued sales without tariff exposure. This geographic diversification strategy protected LVMH from trade disruptions that affected companies with concentrated supply chains. Investor confidence differences between tech and luxury sectors became apparent through institutional investment flows during 2025. Pension funds and sovereign wealth funds reduced their tech allocations while increasing investments in luxury goods companies. These institutional investors sought stable cash flows and predictable dividend payments that tech companies rarely provided. LVMH's consistent dividend payments and share buyback programs attracted conservative investors fleeing tech volatility. Luxury goods served as effective inflation hedges while tech valuations suffered from rising interest rates and commodity costs. High-end watches, jewelry, and leather goods historically appreciate faster than inflation, making them attractive investments during inflationary periods. Wealthy individuals increasingly viewed luxury purchases as portfolio diversification rather than consumption expenses. Louis Vuitton handbags from previous decades commanded premium prices in resale markets, validating their investment characteristics. Consumer preferences shifted dramatically post-pandemic as people prioritized experiences and tangible goods over digital products and services. Wealthy individuals reduced their technology spending while increasing investments in luxury travel, fine dining, and premium goods. This trend particularly benefited LVMH's hospitality and experiential luxury offerings. The company's wine and spirits division grew substantially as people returned to in-person socializing and entertaining. The fundamental business model differences explain why Arnault's approach proved more resilient than Silicon Valley's growth strategies. Tech companies relied on continuous user acquisition and scaling effects that became expensive and difficult to maintain. Luxury brands focused on customer retention and pricing power that generated predictable cash flows regardless of market conditions. LVMH's customers represented concentrated purchasing power that didn't fluctuate with economic cycles, while tech companies served mass markets vulnerable to spending reductions during uncertainty. This stability advantage positioned Arnault perfectly for the aggressive expansion moves that would define his 2025 strategy. While tech billionaires struggled with wealth preservation, Arnault prepared to leverage his financial strength for market domination tactics. The Terminator would eliminate competition and consolidate luxury market control. His most decisive business moves revealed exactly why competitors fear him more than any tech disruptor. The foundation of Arnault's empire traces back to two pivotal moments that demonstrate his strategic brilliance and perfect timing. The first came in 1984 when he made an audacious bet on Christian Dior, acquiring the struggling fashion house for $15 million when most investors considered luxury goods a dying industry. This purchase launched his transformation from construction company heir into luxury empire builder, proving his ability to recognize undervalued assets before markets caught up. The second defining moment occurred during the 2021 Tiffany acquisition, where Arnault demonstrated his Terminator reputation through masterful negotiation tactics. Originally agreeing to pay $16.2 billion for the iconic American jeweler in November 2019, he leveraged pandemic uncertainty to renegotiate terms when COVID-19 struck global markets. His legal team argued that Tiffany had violated deal terms by paying dividends during lockdowns, creating leverage that forced a price reduction to $15.8 billion. This 2.6% discount saved LVMH $400 million while acquiring one of the world's most recognizable luxury brands during maximum market uncertainty. These strategic moves reveal Arnault's core philosophy of patient opportunism combined with aggressive execution. The Dior acquisition required him to recognize that luxury goods represented timeless value rather than cyclical fashion trends. He understood that wealthy consumers would always seek status symbols regardless of economic conditions, making luxury brands recession-resistant investments. The purchase gave him control over haute couture craftsmanship and established relationships with ultra-wealthy clientele who would become lifelong customers. The transformation of Dior from struggling fashion house into global luxury powerhouse demonstrates Arnault's brand revival expertise. He invested heavily in creative talent, hiring innovative designers who modernized Dior's aesthetic while preserving its heritage craftsmanship. Marketing campaigns repositioned the brand for younger wealthy consumers without alienating traditional customers. Retail expansion into emerging markets captured growing luxury demand in Asia and the Middle East. These investments required enormous capital commitments during uncertain times, but they created brand equity that continues generating returns decades later. The Tiffany negotiation showcased how Arnault exploits crisis situations to secure favorable terms. When pandemic lockdowns closed retail stores worldwide, he recognized that luxury brands faced unprecedented challenges that created acquisition opportunities. His willingness to walk away from the original deal created negotiating leverage that forced Tiffany's board into defensive positions. The legal arguments about dividend payments provided technical justification for price reductions, but the real pressure came from market uncertainty that made alternative buyers scarce. Integration strategies following these acquisitions reveal how Arnault builds sustainable competitive advantages. The Dior purchase provided manufacturing expertise and design capabilities that enhanced other LVMH brands. Skilled craftsmen shared techniques across the portfolio, improving quality standards while reducing production costs. Cross-selling opportunities emerged as customers discovered complementary products within the expanded brand family. These synergies created value that exceeded individual brand performance. The Tiffany integration demonstrates similar strategic thinking applied to geographic expansion. The acquisition provided immediate access to established American luxury markets where LVMH previously lacked strong presence. Tiffany's flagship stores and premium locations became showcases for other LVMH brands, creating distribution advantages that competitors couldn't match. The brand's heritage appeal to American consumers filled gaps in LVMH's customer base while providing platforms for future growth. Financial engineering behind these deals optimized capital allocation while minimizing risk exposure. The Dior acquisition used leveraged buyout structures that reduced upfront cash requirements while maximizing return potential. Debt financing allowed Arnault to maintain liquidity for additional opportunities, while tax optimization strategies reduced overall transaction costs. The Tiffany deal employed similar financial structures that preserved LVMH's balance sheet strength for future acquisitions. Timing advantages in both transactions created massive value that patient competitors missed. The 1984 luxury market downturn made Dior available at distressed prices, but most investors avoided fashion brands during economic uncertainty. Arnault's contrarian approach secured premium assets when sellers faced limited alternatives. The 2021 pandemic created similar opportunities as luxury brands struggled with retail closures and reduced consumer spending. His willingness to complete transactions during maximum uncertainty generated returns that exceeded 300% in some cases. These strategic moves established patterns that continue driving LVMH's expansion today. Arnault consistently identifies undervalued luxury assets during market downturns, negotiates favorable terms through superior financial resources, and integrates acquisitions to create synergies across his portfolio. The approach requires enormous capital commitments and patient execution, but it generates sustainable competitive advantages that compound over time. The success of these foundational acquisitions provided capital and expertise for increasingly ambitious expansion plans. Dior's profitability funded subsequent purchases, while Tiffany's American market presence created platforms for broader geographic growth. Each successful integration strengthened LVMH's ability to compete for larger acquisitions while building market dominance that generates increasing returns. This systematic approach to luxury market consolidation created the foundation for Arnault's most ambitious expansion strategy. His proven ability to identify opportunities, negotiate favorable terms, and execute successful integrations positioned him perfectly to capitalize on the world's fastest-growing luxury market, where cultural understanding would prove just as important as financial resources. The Asian Market Domination Strategy. China's property crisis and consumer confidence drop of 20% in mainland luxury spending created the perfect testing ground for Arnault's Asian market domination strategy. His approach began with a simple realization that escaped most Western luxury executives. Asia's wealthy consumers weren't just buying luxury goods, they were buying into European heritage and craftsmanship traditions that represented centuries of cultural prestige. While American tech companies struggled to understand Asian consumer psychology, Arnault recognized that wealthy Chinese, Japanese, and Korean customers viewed French luxury brands as investments in social status that transcended mere material possessions. The China strategy generated over $18 billion in new revenue streams during 2025 through systematic market penetration that began decades earlier. Arnault understood that China's luxury market required patient relationship building rather than aggressive expansion tactics that worked in Western markets. LVMH established manufacturing partnerships with Chinese artisans who learned traditional French craftsmanship techniques while maintaining local cultural sensitivity. The company invested heavily in Chinese language training for European executives and hired local managers who understood regional consumer preferences. This cultural integration approach created authentic connections with Chinese customers who appreciated brands that respected their heritage while offering European luxury experiences. Cultural understanding gave LVMH decisive advantages over Western tech companies that treated Asian markets as extensions of American consumer culture. Apple and Google struggled to adapt their products for Chinese consumers who preferred different user interfaces and payment systems. LVMH's approach involved deep cultural research that revealed how luxury consumption patterns differed across Asian countries. Japanese customers valued understated elegance and perfect craftsmanship, while Chinese consumers preferred bold status symbols that communicated wealth and success. Korean luxury buyers sought cutting-edge design elements that reflected their country's technological sophistication. Exclusive partnerships with Asian luxury retailers and distributors created competitive advantages that locked out Western competitors. The strategic alliance with China's Shangri-La hotels provided LVMH brands with exclusive retail space in premium locations frequented by wealthy travelers. Partnership agreements with Japan's Isetan department stores secured prime display areas for Louis Vuitton and Dior products in Tokyo's most prestigious shopping districts. These exclusive arrangements prevented competitors from accessing the same high-traffic retail locations while providing LVMH with valuable customer data and purchasing pattern insights. Localized marketing campaigns resonated with wealthy Asian consumers through culturally specific messaging that celebrated both European heritage and Asian achievement. LVMH's Chinese New Year campaigns featured limited edition products designed specifically for Chinese customers, incorporating traditional symbols and colors that carried cultural significance. The company sponsored major cultural events in Asia, including art exhibitions and fashion shows that showcased European craftsmanship within Asian cultural contexts. Celebrity endorsements featured prominent Asian business leaders and cultural figures who embodied the success and sophistication that LVMH brands represented. Supply chain investments enabled rapid Asian market expansion through manufacturing facilities and distribution networks specifically designed for regional requirements. LVMH constructed state-of-the-art leather goods workshops in China that combined European craftsmanship techniques with local production capabilities. The company established perfume blending facilities in Japan that created fragrances tailored to Asian preferences while maintaining French quality standards. Regional distribution centers in Singapore and Hong Kong provided efficient logistics networks that reduced delivery times and improved customer service across Asia-Pacific markets. Geopolitical tensions between the United States and China created unexpected opportunities for European luxury brands as Chinese consumers shifted purchasing preferences away from American products. Trade disputes and technology restrictions made Chinese customers wary of American brands, creating market share opportunities for European alternatives. LVMH benefited from China's preference for European luxury goods that represented neutral cultural values rather than American political influence. The company's French heritage provided competitive advantages in Chinese markets where consumers viewed European brands as culturally sophisticated alternatives to American technology products. Strategic store locations in prime Asian luxury districts demonstrated LVMH's commitment to long-term market development rather than short-term profit maximization. Flagship stores in Shanghai's Nanjing Road, Tokyo's Ginza district, and Seoul's Gangnam area occupied the most expensive retail real estate in Asia. These locations generated massive foot traffic from wealthy local customers and affluent tourists who viewed shopping at these stores as essential luxury experiences. LVMH's heritage brands appealed to status-conscious Asian consumers who valued products with documented histories and cultural significance. Louis Vuitton's 170-year heritage resonated with Chinese customers who appreciated brands with generational legitimacy and proven quality. Hennessy's cognac production traditions spanning over 250 years attracted Japanese consumers who valued craftsmanship techniques passed down through generations. These heritage narratives provided emotional connections that justified premium pricing while differentiating LVMH brands from newer luxury competitors lacking comparable historical credentials. Asian market success contributed significantly to Arnault's wealth growth in 2025 through revenue streams that represented over 35% of LVMH's global sales. Chinese luxury consumption alone generated $12.4 billion in LVMH revenue during 2025, representing 67% growth from previous year levels. Japanese markets contributed $4.2 billion through consistent purchasing patterns that remained stable despite economic uncertainty. Korean luxury spending reached $2.8 billion as younger wealthy consumers embraced European luxury brands as lifestyle statements. The timing of Asian market investments proved prescient as wealthy Asian consumers increased luxury spending while Western consumers faced economic uncertainty. Chinese billionaires maintained luxury purchasing patterns despite global market volatility, treating European luxury goods as stable investments during uncertain times. This stability revealed something profound about Arnault's business model that tech companies completely missed. The inherent durability and timeless appeal of traditional craftsmanship created advantages that no amount of innovation could replicate. The sustainability advantage that tech missed. This timeless appeal revealed a sustainability advantage that tech companies completely missed while chasing the latest innovations. Arnault's focus on craftsmanship and durability accidentally created the most powerful environmental positioning in business, while tech companies struggled with mounting criticism over electronic waste. A Louis Vuitton handbag from 1980 still functions perfectly today and commands premium prices in resale markets. The same leather goods that wealthy customers purchased decades ago continue serving their original purpose while maintaining aesthetic appeal that transcends fashion trends. This longevity contrasts sharply with smartphones that become obsolete within 3 years and laptops that require replacement every 5 years. The planned obsolescence model that drives tech profits became a massive liability when wealthy consumers started prioritizing environmental responsibility. Apple deliberately designs iPhones with limited lifespans to encourage frequent upgrades, generating recurring revenue through forced replacement cycles. This strategy worked brilliantly for decades but created enormous electronic waste problems that environmentally conscious consumers increasingly rejected. Meanwhile, Hermès scarves from the 1950s remain fashionable and functional today, demonstrating how luxury goods provide sustainable value through timeless design and superior construction quality. Environmental initiatives throughout 2025 enhanced LVMH's brand value among customers who could afford to prioritize sustainability over convenience. The company invested $2.3 billion in renewable energy systems for manufacturing facilities across Europe, creating carbon-neutral production processes for leather goods and spirits. Solar panels and wind turbines powered Louis Vuitton workshops in France, while biomass energy systems heated Hennessy distilleries in Cognac. These investments required substantial upfront capital but generated marketing value that justified premium pricing among environmentally conscious wealthy consumers. Traditional craftsmanship skills became more valuable than technological innovation as consumers sought authentic alternatives to mass-produced goods. Master leatherworkers who spent decades perfecting traditional techniques created products that machines couldn't replicate. The human skill required to craft luxury goods by hand appealed to customers who appreciated artisanal quality over technological efficiency. These craftsmen commanded premium wages while creating products that justified luxury pricing through superior quality and authentic production methods. The circular economy created massive opportunities for luxury goods that didn't exist in technology markets. Vintage Louis Vuitton luggage and Hermès handbags appreciate in value over time, creating secondary markets that support new product sales. Wealthy customers feel comfortable purchasing expensive luxury goods knowing they can resell them later for substantial portions of their original prices. This resale value provides financial justification for luxury purchases while creating sustainable consumption patterns. Technology products face the opposite dynamic: rapid depreciation and obsolescence that eliminate resale value within years. Heritage and timeless design proved more sustainable than constant technological upgrades that created environmental waste. LVMH brands maintain consistent aesthetic principles across decades, ensuring products remain stylish and relevant regardless of changing fashion trends. A Cartier watch from 1985 still represents sophisticated taste and quality craftsmanship today. This design longevity eliminated the need for frequent replacement purchases while maintaining brand value and customer satisfaction. Tech companies struggled to create products with comparable longevity because technological advancement made older devices functionally obsolete. The investment in sustainable materials and production processes required massive capital commitments that smaller luxury companies couldn't match. LVMH spent over $1.8 billion developing sustainable leather alternatives, organic cotton sourcing, and recycled precious metal programs. These investments included partnerships with environmental organizations and research institutions that developed innovative sustainable materials. The company's financial resources allowed sustained investment in sustainability initiatives, while competitors struggled with financing constraints that prevented comparable environmental programs. Environmental impact measurements demonstrated how luxury goods created less waste than technology products despite higher prices. A single Louis Vuitton handbag used for 20 years generated less environmental impact than the multiple smartphones a person replaced during the same period. The durability of luxury goods reduced consumption frequency while maintaining customer satisfaction through superior quality and timeless design. This environmental efficiency appealed to wealthy consumers who wanted to minimize their ecological footprint without sacrificing lifestyle quality. The carbon footprint advantages of luxury goods became apparent when compared to technology products requiring frequent replacement. A single Hermès handbag used for decades generated less carbon emissions than the multiple laptops and smartphones that technology consumers replaced during the same period. The manufacturing energy required to produce luxury goods spread across years of usage created more efficient environmental impact than technology products with short lifespans. This environmental efficiency provided additional justification for luxury pricing while appealing to environmentally conscious wealthy consumers. Worker welfare programs in LVMH production facilities created social sustainability advantages that enhanced brand value among socially conscious customers. The company invested in training programs that preserved traditional craftsmanship skills while providing workers with stable employment and fair wages. These social investments created positive brand associations that justified premium pricing while supporting local communities, where LVMH operated manufacturing facilities. This sustainability advantage represents more than environmental marketing. It reveals fundamental strengths in Arnault's business model that become more pronounced during challenging economic conditions. While tech companies face increasing pressure to address environmental concerns that threaten their core business models, luxury goods naturally align with sustainable consumption patterns that wealthy customers increasingly demand. The future-proof empire. Building this sustainable foundation positions Arnault's empire to withstand challenges that would destroy tech-dependent business models. His approach operates on principles that become more valuable as economic conditions worsen rather than better. While tech companies depend on consumer confidence and discretionary spending that evaporates during recessions, luxury goods serve emotional and social needs that wealthy customers prioritize regardless of market conditions. The ultra-rich actually increase luxury spending during economic uncertainty because they view premium goods as stable investments that preserve value better than volatile financial markets. This countercyclical demand pattern creates recession-proof revenue streams that tech companies cannot replicate through their mass-market approaches. The generational wealth transfer currently happening ensures continued luxury demand for decades ahead. Baby boomers worldwide control approximately $70 trillion in assets that will transfer to younger generations over the next 20 years. These wealth transfers create new luxury customers who inherit both financial resources and established relationships with premium brands. Third-generation billionaire families maintain purchasing relationships with LVMH brands that span multiple decades, creating customer lifetime values that exceed anything tech companies achieve through subscription models. The wealth transfer process actually accelerates luxury consumption as younger inheritors use premium purchases to establish their own social status and identity. LVMH's brand portfolio adapts to changing consumer preferences without losing core appeal through strategic innovation that preserves heritage while embracing contemporary trends. Louis Vuitton maintains its traditional leather craftsmanship while incorporating modern materials and production methods. Dior preserves haute couture traditions while creating ready-to-wear collections that appeal to younger affluent consumers. This adaptation process requires enormous research and development investments but allows established brands to remain relevant across generational changes. The portfolio's diversity spreads risk across multiple luxury categories that respond differently to changing consumer preferences. Innovation investments keep luxury brands relevant without losing exclusivity through carefully managed technological integration that enhances rather than replaces traditional craftsmanship. LVMH invested $1.2 billion in digital technologies during 2025 while maintaining hands-on production methods that create authentic luxury experiences. Augmented reality applications allow customers to visualize products without compromising the exclusive in-store experience. Blockchain technology verifies product authenticity without changing traditional manufacturing processes. These technological enhancements support luxury positioning rather than undermining the exclusivity that justifies premium pricing. The scarcity model becomes more valuable as wealth inequality increases because growing numbers of billionaires compete for limited luxury goods. Global wealth concentration creates expanding customer bases for ultra-premium products while maintaining artificial scarcity that drives pricing power. When 10 billionaires want the same limited edition Hermès bag, competitive bidding increases final prices beyond normal luxury margins. This scarcity dynamic becomes self-reinforcing as wealthy customers pay premium prices for exclusive access to products that demonstrate their financial capacity to others in their social circles. Geographic expansion opportunities still available to LVMH include emerging markets where new wealthy populations seek luxury goods that signal their success. African markets present enormous growth potential as resource wealth creates new billionaire populations seeking status symbols. Latin American luxury consumption continues growing as established wealthy families expand their purchasing patterns. Middle Eastern markets offer expansion opportunities through cultural partnerships that respect local traditions while providing European luxury experiences. These geographic opportunities provide decades of growth potential that tech companies cannot access through their saturated global markets. Luxury goods serve as stores of value during economic uncertainty because they maintain purchasing power better than financial instruments. During inflationary periods, high-end watches appreciate faster than inflation while providing immediate utility and social signaling. Rare wines and spirits increase in value as aging improves quality and reduces available supply. Jewelry and precious metals serve as portable wealth that retains value regardless of currency fluctuations. These investment characteristics appeal to wealthy customers who view luxury purchases as portfolio diversification rather than consumption expenses. Succession planning ensures continuity beyond Arnault's leadership through carefully structured management transitions that preserve family control while incorporating professional expertise. The Arnault family maintains majority control through holding company structures that prevent hostile takeovers while allowing operational flexibility. Next-generation family members receive extensive training in luxury brand management while proving their capabilities through increasing responsibilities. Professional management teams provide operational expertise while family members maintain strategic oversight and cultural continuity. The luxury market's growth trajectory outpaces tech market saturation because wealthy populations continue expanding faster than luxury supply increases. Global billionaire populations grow at approximately 7% annually while luxury production capacity increases at only 3% per year. This supply-demand imbalance creates pricing power that tech companies lose as their markets mature and competition intensifies. Luxury brands benefit from artificial scarcity that maintains premium pricing while tech companies face margin compression from competitive pressures and market saturation. Traditional luxury production methods create competitive advantages that tech companies cannot replicate through rapid scaling or venture capital funding. Master craftsmen require decades of training to achieve expertise levels that justify luxury pricing. Heritage brands benefit from cultural associations that develop over centuries rather than marketing campaigns. These competitive moats protect luxury brands from disruption while tech companies face constant threats from new entrants and changing consumer preferences. Arnault's empire positions itself to remain dominant for decades while tech companies face increasing challenges from market saturation, regulatory pressure, and competitive disruption. The luxury market's fundamental economics create sustainable competitive advantages that cannot be replicated through technological innovation or venture capital funding. Patient capital investments in brand building and craftsmanship expertise generate returns that compound over decades rather than quarters. This long-term approach creates wealth that survives market cycles and technological disruption, revealing something profound about which business models actually create lasting value in an uncertain world. The numbers from 2025 tell the complete story about which business models actually survive market turbulence. LVMH's Q1 2025 sales fell only 3% while tech companies experienced 23 to 30% swings in valuation, underscoring the fundamental resilience of luxury economics over digital disruption promises. While tech billionaires lost hundreds of billions through stock volatility, Arnault's empire generated steady profits by serving customers who view luxury goods as investments rather than expenses. His success reveals a fundamental truth about wealth creation. Controlling scarcity generates more sustainable returns than chasing scale. Perhaps lasting wealth comes from understanding human psychology rather than disrupting industries through venture capital funding and growth hacking strategies.